Is Frank joining us?
Do we want to do Brady Bunch or do we want to do the speed?
We need 3 more people, and then what you have to do is you all have to look at each other.
Marsha.
Exactly. No, Frank has he has a training right now. So we do a Friday training with a mortgage broker, their company, and so he's dealing with that today. So I'm gonna be the sole representative.
All right. All right. Well, we'll let everybody get logged in, and I'll start here in a couple minutes. We had almost 900 registrations, so we should have a pretty packed audience today.
Cool. Who called?
And I'm back.
Back with a vengeance,
Yes, sir.
like the market's going to be.
How is the market doing, Barry? It's not rate market, stock market.
So it's markets are closed today, but I thought it was very interesting to see exactly at the 50% Fibonacci retracement between the high of the 19th of February at 33.93 on the S&P and the 21.92 kind of stopped there and backed off. What normally happens at this point is you do get a pullback and you could see some lower prices, but we'll see.
We saw the biggest week's gain since 1974. I saw.
Oh, really?
Yeah.
Wow.
Yeah, it did. It did have quite a week, but this is an area I think that we're due for a pullback, but we'll see. I certainly could be wrong.
All right, we're going to get started here. Good morning, Loan Nation, and welcome to the first edition of Titans. I am your host, James Polinori, co-founder and president of Loan Officers of America Network. As you know, it's been another wild week in the mortgage industry amidst the coronavirus pandemic, and we've got a power-packed panel with us today discussing the current state of events. Industry voice and CEO of MBS Highway, Barry Habib, is on with us this morning. Anthony Casa is the president of the Association of Independent Mortgage Executives and a champion for the Mortgage Broker Channel. Also joining us is the CEO of Geneva Financial and recently featured in National Mortgage News as a top 5 mortgage employer, VanTrojen. And we've got half of everyone's favorite morning show host, Brian Stevens, here with us. Frank Gray could not join us today, unfortunately. So Brian is stepping in. Good morning, gentlemen. Thank you all for being here today. I know you're all busy, and it means a lot that you took the time out to educate our audience.
We're happy to be with you too, James.
Thank you.
Yeah, and I'm no redheaded stepchild over here. Okay, you didn't.
No, you're not.
Me.
You're the better half. You're the better half.
You couldn't get Frank, so damn it, I guess we get this.
Didn't get the Frank, we got the beans. So Barry, before we get to the viewer submitted questions, I want to kick things off with an up-to-the-minute recap of where we're at as an industry. The end of yesterday's news cycle saw a bipartisan letter from the Senate pushing FHFA Director Mark Calabria to reconsider liquidity facility, and now the Fed has announced a $2.3 trillion lending package. Are we finally seeing some good news this morning, and what does it all mean?
Well, you know, we are, the lending package really was silent on trying to help the mortgage industry. However, it was really interesting to hear Fed Chair Powell. I think that he kind of tried to make the point in a public way that the mortgage industry is critical to our economy and critical to the housing market, which will lead us out. So it was really encouraging to hear that. And from what I understand, Mark Calabria and the Treasury Secretary Mnuchin have been less than eager to help. I know that both Anthony's done a great job, and Brian, you and Frank have done a great job and reporting lots of this up to the minute stuff, and certainly we've tried to do that as well. But it appears that the head of the FHFA, Mark Calabria, is estimating that the request for forbearance be much lower than what the MBA is warning they could be. And his early numbers are more modest. You know, I spoke to the president of the MBA, Bob Brokesmith, and I think what we agree is that it would be naive to think that consumer behavior is one where they do everything in advance. I think we all know people wait till the last minute. So I think it's possible to see, and maybe likely to see, an acceleration as we get to at least the 15th to next week. And then definitely by the 30th that we start to see some more of these forbearance issues. So this is difficult for many mortgage servicers because there's a lot put on them. It seems that the FHA part is in good shape now because of the partial payment facility that's in place, which would, according to the waterfall, you know, you try and get the money back, but if you go all the way down the waterfall, worst case scenario, you could use it as a second lien by what's called a secretary's lien, but the money from that lien would be advanced to the servicer and bring the loan current. As you know, we don't have this currently on conventional loans, which represent a large segment of this. So we're still in a position of the unknown, but when we get to it, I'd like to talk about where we go from here, what the next two phases of things are for us, and where the opportunities are when we get to that level.
Yep. And that's one of the questions on the panel here. We will definitely get to that. So Anthony, it's been another dismal week for jobs numbers, another 6.3 million in unemployment claims this week, totaling nearly 17 million jobless Americans in the past 3 weeks. What are you anticipating for next week, and will the federal efforts we're seeing make a difference?
I think a couple things. I think, you know, I'm going to go on the general guidance that the projections that we heard earlier were 40 to 50 million jobs lost. So, you know, most likely we're going to see a continuation of these numbers. Even if we get half as many next week, it's still a lot of people. I think the big thing that we have to consider is really, you know, the percentage of people that are not going to return to jobs. So, you know, the most optimistic number is 90% will return to jobs. So if 10% don't, and 10% of 17 million is 1.7 million, that's still tremendous job loss. So, you know, as we get higher and higher to 30, 40 million jobs potentially lost, and we think about the ramifications of, you know, 10% of those jobs or 15% of those jobs really, truly lost, it's going to take a long time to, you know, recover. And I think people, you know, we need to be optimistic, but at the same time, we have to be realistic. Like, you know, losing 3 or 4 million jobs is going to take, you know, a good month for job gains is 300,000. So think about how do we get to that 4 million? It's, I think we'll prove we're resilient, and I'm looking forward to it.
Good. So Aaron, there's talk of reopening the economy as early as May 1st, with heavy debate on whether to do a rolling open or just go for it and open everything all at once. What do you think would be most beneficial specifically for the mortgage industry?
Well, I know that a lot of people in this industry have been very outspoken about getting this thing going. A lot of our problems go away once people get back to work. I think the federal government, personal opinion, was terribly slow at handling this. I think they continue to be slow at handling this, and which is largely why we're in the situation we're in today. And I think that if we get ahead of ourselves and just open up the economy too fast when people are still getting sick, we still don't have the numbers of people that are infected, the last thing I want to do is get the engine running again and then have to pull all the way back because people start getting sick, because that's exactly what is going to happen if we get too fast in trying to reopen the economy. And trust me, there's probably nobody on the screen that wants this more than I do to get people going back to work, because the fear of, you know, forbearance and repurchases is front and center on my mind. So I would prefer that they take it slow, roll it out slow and cautious. And once we do, you know, hit the gas and get people to start going back to their jobs, and still try to, you know, continue the social distancing for some time to reduce the likelihood of this, you know, just coming right back and having us back in the same situation we're in. And just real quick, off subject, that I want to just make this comment real quick as the only non-celebrity on this this webinar right now, is when we started promoting this event, I got an overwhelming amount of private messages about having me and Anthony Casa on this. And I think that there's a lot of people that were going to come on the show just to see him and I duke it out, because we've had some, disagreements in the past. And what I want to make sure everybody knows in the records, put this on the record, is I started my company in October of 2007, going into the Great Recession. And at that point in time, even though I was a licensed mortgage banker, nobody would give me any money. So I started my career as a broker. And we maintained as a broker for quite some time. In fact, I was the president of the Arizona Association of Mortgage Brokers until they put their tail between their legs and called themselves professionals because they were scared to represent who they were. And I was adamantly opposed to that. And while Anthony and I have had some disagreements, I think his message for the last month has been on point. And it has nothing to do with brokers versus bankers. It has everything to do about this industry. And what I hope, and I think it's happening right now, is that his messaging and the messaging from even the bankers is bringing us together as a group. And I hope we hang on to that, because we need one another. We need one another to survive in good times and in bad times.
Yeah, I think that, one of the big things that is definitely going to come out of this, and Barry and we've spent a lot of early morning conversations talking about this, is there's been an education on what this ecosystem is. And whether you're a broker or a loan originator, the perception was I originate, I close a loan with my wholesale lender or my retail employer, and that's it. But there's so many more pieces to the puzzle that are so big. And when you start understanding, what servicing really is and how important they are to the market, and how, their issues impact the front lines very quickly, you have to reevaluate, your stance and your view on a lot of different things. And I think right now there's a healthy education that's happening with all loan originators. Loan originators know about margin calls. They know about, MSR. They know about things, I'm learning every day as well. So I think it's a healthy thing within the industry that's going to happen. And there's no doubt that what the industry looks like a year, this is going to have a very big impact on the economics of the mortgage industry. So, for me, I think it's been good and it's been healthy to bring everybody together and kind of reconcile not the frontline issues, but what's going on behind the scenes. And then you have a greater appreciation for, all the participants.
Yep. And that's a very specific reason why I brought this panel together, because you've all been very vocal and in supporting the industry and guiding people and offering that amount of time to do that. And if this industry comes out of it, you guys are going to be partly responsible in not a small way of helping us out of it. So that's really important, and I'm happy to see it. Brian, so recently there was an economic pulse flash survey by the National Association of Realtors. It found that 59% of its agent members believe that buyers are merely delaying home purchases for a few months. 57% believe listers are doing the exact same thing. And the NAR chief economist also stated that home prices may dip for the next couple of months, but anticipates will be back full swing in the fall. What are your thoughts on that?
Well, I think before we even get to the housing, we have to make sure that we've got liquidity in the mortgage market and to ensure that this is going to happen. And we're seeing problems right now. Barry and Aaron were talking about, Mark Calabria and the measures he's taken. It seems to me that Jenny's done a pretty good job of this so far. They've got their pass-through assistance program in place where they are ensuring that the mortgage-backed security investor is going to be made whole, and then they're going over to HUD to recapture that money. That looks like a fairly good plan. Now, Calabria came out and said he wasn't going to do the same thing because he only sees 3.5% of all mortgages going into forbearance right now. Well, here's the problem. If you look at a servicer like Mr. Cooper, who's the largest in the country right now, they have a forbearance on 86,000 loans. They're doing 22,000 per day, and their wait time on the phone has gone from 2 minutes to 17 minutes. And right now, just today, I saw a JP Morgan Chase economist that's calling for 20% unemployment this month. What's happening right now is they're not able to deal with the forbearances as quickly as they're coming at them. And one of the things that Calabria is talking about doing is stripping the non-banking entities, the 40% of servicers out there who are servicing nearly half of the $7 trillion in mortgage-backed securities, and handing that over to the depositories. Well, which depository is going to want to take on a bunch of toxic assets that just keep on growing and growing? They've got a plan in place that needs to be addressed, so we ensure that we've got liquidity in this market, so both mortgage bankers and brokers can go forward and offer great rates at great prices, which is what should be happening right now, better than what they are. With regards to people at their house going for homes, nobody can go to houses right now. In fact, in the state of Pennsylvania and the state of Arizona right now, real estate appraisers aren't able to go do full inspections, interior inspections. So those two states have essentially shut down 95% of your government loans. You could have somebody who wants to buy a house ready, willing, and able, but the processes and systems and decisions that we have in place right now simply aren't allowing people to do this. So I think we need to address this from a policy standpoint before we start looking at what the desires of consumers across the country are trying to do. Personally, what I think it's across the board. I think certain markets are going to be hot. It seems to me that even when we come out of this thing, if we're sitting at 20% unemployment, and Barry can speak to this better than I can, but even when we come out of this thing, you're going to be looking at people who are underemployed. They're not going to be going back to work full time. You might be opening up some of these restaurants, but they've got, their 6 feet separation, so they can't fill them up. And that's not going to sustain most of the restaurants across the country right now. So we've got a lot of issues, I think, with the economy that we need to look at before we start considering buying houses. And I think your average person is sitting in their house right now, and I think they're more concerned about their health, their family, and their finances than going out there and buying a new house. But I will say this, as from a loan officer perspective, okay? When we make our calls to our past client database, whatever type of marketing that we do, you're catching some guy or some gal who's got an hour commute and horrible traffic. They're getting home. They're pissed off because their boss is a jerk. Their kids' homework is all messed up. They just want to get a bite to eat, grab a tumbler, have a drink, and, tune things out. And so when we call these people up, they're all stressed out because their day has been filled. A lot of people right now are sitting in their house, twiddling their thumbs, trying to figure out what's going on. As a loan officer, this is a great time to reach out to your past client database. There's going to be winners and losers that come out of this thing in the mortgage and real estate space. And the people who are proactive right now, sitting in their houses, time blocking, reaching out to their past client database, and letting them know that they need to consider what their housing and mortgage needs are. And, a lot of the loan officers that I've spoke with are talking about taking people from 30 down to 20 and 15-year notes. So I think right now what a loan officer needs to do is go out there, time block, call their past client database. And I think real estate agents need to do that as well, because houses still are in fact selling. There's not going to be much of a desire. We might see foreclosures tick up a little bit. And if prices drop by 2 or 3% in the short term, or 4%, again, Barry could speak to this better than I can, then that just means with our great rates, our great programs, and lower housing prices, it's going to be an optimum time to buy. It's like what Warren Buffett said, buy when people sell when people buy.
Yep. Love it. So those are the topics that I wanted to make sure that we covered, and that did cover a bunch of questions that were sent in. We had viewers send in questions ahead of time. So now we're going to get into their questions. Barry, I'd like you to take this one first, and then we'll pass it off to Anthony to follow up. Mark Weber wants to know if big banks are using their government influence to block or delay liquidity support in an effort to suppress independent mortgage operations.
Yeah, I can't speak to that. I'm not on the inside, and I don't know what's going on. It does raise questions as to why Mark Calabria, why when this was rolled out from Secretary Mnuchin, they didn't just learn from the past. And I think it's also naive to think that there's not room for abuses. Why couldn't we mitigate this to a great extent by saying, if you want to use forbearance, you have to prove hardship, show us that you've lost your job. And that would just reduce the amount so much, because what's happening now is some real estate agents maybe not realizing the harm they're doing, because you can hurt real estate values, which doesn't do you any good, by the way, and hurt that individual's potential to purchase another home, not just refinance, but to purchase another home if they went into forbearance. Real estate agents are out there saying, oh, just like it's a furniture sale, hey, buy a home for me, first 12 months, no payments, and I just think that's a mistake. I think that Calabria was wrong and Mnuchin was wrong in not requiring proof. I don't know why, and I can understand, James, as to why people may think that there may be an ulterior motive, because you think it's so logical, and why Calabria has turned a cold shoulder, and he's been kind of cavalier with some of the remarks, like, oh, well, that's just spin. There is real pain being felt on this, and let's all remember that this came on the heels of the margin call issue, which I'm very proud of what I was able to do, and there's in no small part to the help that everybody on this screen and everybody that's listening by taking that article and helping out with media outlets. We got the Fed to hear us, and we stopped the margin call issue. But it seemed like the second that stopped, with a depleted cash position and now a need to close loans, you're saying and asking a lender to play Russian roulette with, do you want to close that loan? Because if it's a conventional loan, and if that loan has a first payment default because of forbearance, you're not going to be able to sell it. It's going to sit on your warehouse line. And for every loan that sits on your warehouse line, it's got a doubling effect because you are able to turn that warehouse loan twice. And Aaron, you're certainly at the front lines of understanding how this works, where if you got a warehouse line, if you got a warehouse line for $1 million and you got to buy back, or you can't sell a $300,000 loan, well, a warehouse line of $1 million means you can close $2 million. But if you have one $300,000 loan, that means you can only use $700,000 twice. You can now close, instead of $2 million, $1.4 million. So it has a very detrimental effect. Now, I'm seeing creative things like selling certificates, like PennyMac is doing for advance of the payments, of basically pledging what they have. I think it's very creative, and I believe sincerely we're going to make it through this. I know that we're going to make it through this, and I'm anxious to talk about what it looks like on the other side. But what I also want us to understand is that it is my sense that Calabria won't take action on this until there are some potential casualties. I pray that there are none, because there's real families there and good people. But once a couple of casualties come, I don't think that there would be a decimation of the industry. But I fear that unless we get a little hopeful and lucky, that Calabria might not take action until we see something bad happen, similar to a Lehman moment back during the financial crisis, before everybody said, oh my gosh, we really have to do something. Then you saw AIG get, so I think that there are things that unfortunately might happen. I pray that they don't, and maybe with the creativity they don't, but I don't think it will be a total collapse, because I think once we start to see some bad things occur, then they'll step in. But it's like you ever see there has to be a couple of fatal accidents on a bad intersection before they put up a traffic light. You know what I'm saying? So it's that kind of an analogy. Now, one more point here is that when we get to the other side of this, which I know we will, the reason why we all have to pull together, and I'm so glad that the message is that, and the originators out there have to do whatever you can do to help your company navigate these really dangerous and tricky waters, is because the other side of this is so unbelievable. But it happens in two phases. So I'll let Anthony kind of pick it up from here. But when we come back to this, James, I really want to try and explain to people what I see for real estate and opportunity, what we should be doing, and what the world looks like, and when we should get there.
Yes, we will circle back to that. Anthony.
Yeah, so I think it's I don't really want to get into the FHA, what Mark Calabria is doing. We actually have a call set up with their office, and we're our position at this point is that there's a lot of politics and a little bit of a game of chicken that's being played. So that's to be expected when you're talking about hundreds of billions of dollars in bailout. So I think he's just playing that game. I don't think anybody believes that if push comes to shove, they're going to let companies that have thousands of employees and impact local communities across the country go out of business. So I would say that the most important thing right now is loan officers understanding how important of a role they play in all of this. I had a loan officer post something yesterday. It said, customer, is closing on Monday, asked me, how fast they can apply for forbearance. So, for me, what moment we're looking at right now is it doesn't matter what channel you're in, doesn't matter what company you work for. This is like, this is either you're a mercenary or you're a patriot. And right now you have to understand that you making $5,000, $6,000 on this deal at the expense of your company or a wholesale lender, or whoever it is. It really doesn't matter at this point who your employer is or who's getting impacted, but the cumulative effect on that will kill people, and the government's not going to bail them out. Like, plain and simple, if you just see a wave of people closing loans, knowing that people are going to ask for forbearance, what needs to happen is if you instruct them to talk to their existing servicer, you don't close on that deal if it's a refi, And unfortunately, that's a painful message. But I know Aaron, I know a lot of entrepreneurs that run mortgage companies, and the pain that they're under today will only get massively worse if they start closing loans and their phone rings 2 minutes later and it's the customer saying, "Hey, it's time. I want my forbearance, and I don't have to prove hardship." So, it's a painful thing. And I know a lot of people out there are going to roll their eyes and not do that. But the truth of the matter is that's doing the patriotic thing for our industry and really looking at the big picture and understanding that we're coming off a record quarter. We're coming off a great year last year. We've all made a lot of money. If you're a loan officer or an originator at any point over the last 18 months, you've done very well for yourself. We can afford to have a bad month. We can afford to have a bad couple months. And I hope that people do some, internal thinking and really, make the hard decision.
And there's culpability too, because, if you know about this and you don't disclose it, there could be some liability to the LO. And in addition to that, like you said, Anthony, this is really stupid short-term thinking that a couple of $1,000s or whatever it is, it's not worth it because you're jeopardizing your career. I mean, you have to stop thinking like a bar. You have to start thinking like a CEO of your business for your family's good, because you might write an extra loan or close an extra loan, but at what cost if the industry looks very different? There's going to be a lot of changes, and I want people to be prepared for them. Get ready. It's going to be harder. It might be more customary to do a loan with 1 point. It might be difficult to get a 60-day lock. It's going to be much more difficult to get loans where you're going to pay for closing costs. There's going to be more verifications prior to close. There is going to be a different environment that we're in. Now, the more we do today, the easier it is later on, because you always fight the last war. So please think about that. Please think it's your responsibility. It is there's no, oh, my deal doesn't matter. Every deal matters. Every single one matters.
Yep. Aaron, John Nguyen would like to know what the outlook is for all of the non-QM business that has been impacted. As we know, I'm not doing a lot of those right now. When there is a correction, does it come back the same? Or does it come back slowly, or does it come back at all?
Again, a personal opinion, I think all of it's coming back. There wasn't necessarily anything inherently wrong with non-QMs. In fact, some could argue that was better than most of the FHA loans that we do as an industry. Typically high credit score, lower LTV, so on and so forth. Those for the most part were high quality loans and still are today. They potentially even have the lowest chance of going into forbearance because you have higher net worth people in most cases, so on and so forth. The problem with non-QM is there's no purchasers for those type of mortgages. So, and we see that even with agency and government right now, is the values of mortgages are in the toilet, and a higher risk niche product like non-QM was going to be the first one that was going to fall. I do believe that there's going to be a resurgence of non-QM. I don't think there's any reason why there wouldn't be. It's probably not going to happen overnight. Some of these non-QM lenders that were leaders in that space may not make it through. And so you might have a limitation on the amount of products that are available just simply because there's fewer companies offering those products. But again, when people start going back to work and forbearances start to fall, I think non-QM is going to come back very similar to where it was before. It might take some time.
Brian, any thoughts on that?
I completely agree with them. There's too much of a market for non-QM. In fact, non-QM should have been around 5 years before it was around. Your self-employed borrowers who were basically left in the dust after the 2008 recession. Non-QM will come back there. When our economy recovers, there's going to be a thirst for those notes, and there's going to be investors who are going to want a better yield on, any type of mortgages. I want to go back over to what you were talking with Barry about with Calabria and the FHFA real quickly. If he has a bone to pick, so to speak. I had a conversation with Dave Stevens a couple of days ago, and we were discussing what was going on over there at the FHFA. And Dave Stevens is pretty precise with his words, doesn't speak out of turn. He wrote back to me, and he had 3 things to say. He said, unreal, deadly, and anti-non-bank. And, I think that kind of speaks volumes, with the decision-making that's taking place over at FHFA right now. Maybe they do have a bone to pick. Maybe they're not non-bank right now. But again, this is problematic because in 2008, or whenever we've had any of these pass-through assistance programs, it's always been relegated to specific areas of the country: tornadoes, hurricanes, fires, floods, that type of crap. In 2008, you had to prove hardship, but right now, all you have to do is say that you're being affected by COVID-19, and you can go ahead and forbear for 6 months and then get an extension for 12 months.
Yep.
Anybody in the country. So this is nationwide, and it's completely unprecedented, and it's creating a whole bunch of problems on the back end. And so, yeah, I mean, and the ones who it's affecting first are going to be the non-depositories. And so we really need to see the FHFA doing something different. We really need to see our industry pressuring the FHFA through our associations, through our advocates, and let them know that they need to change course, and they need to change course soon.
Yep. Barry, several viewers asked about rates, of course, and how soon we might see a drop with the government lending package as of today. What kind of timeline are you predicting for rates, and do you expect we'll see historic lows once we're deeper into the oncoming recession?
Okay, so this is so closely tied, this whole situation, to what's going on with the medical side of things. And I do speak to the head of the Cleveland Clinic a couple of times a day. I did speak to him before I got on this call. They're currently trying to do something to get the state of Ohio opened as kind of leadership before the first of the month. And what we're seeing is that there is some promise with some of the therapeutic treatments, and also seasonality plays a big role. So you can expect to see, like normal viruses, they tend to subside. But as things start to reopen, it'll be like an unlockdown period. And that unlockdown period is still not going to feel normal, because we're not going to be shaking a lot of hands. We're not going to be getting close. We probably aren't going to feel comfortable sitting in the middle seat of a plane, or even perhaps on a plane at all, certainly not next to somebody in a theater or a crowded bar or restaurant. There's so many instances that you could think of in normal life that you never thought twice of, where you were next to somebody, or next to a bunch of people. And you just think of all those businesses and how difficult it will be to be in a situation like that. The real change will occur when there is a vaccine. And what I'm hearing is that, unlike what was first thought, that it would be a much longer process, there is a tremendous amount of optimism and real hope that could happen prior to the end of the year. Now, look, that's still 7 or 8 months away. So you might say, goodness, that feels like an eternity. But the truth of it is that 7 or 8 months tends to pass pretty quickly. Maybe not when you're in pain, it's slow, but it does pass. And that's when we can see the economy recover. So people are talking about, what kind of recovery? Those that say it's a V shape, meaning it goes really down fast and really up fast, I think that's just fool's game. That's not going to happen. That's just ridiculous. Those that say it's a U-shaped recovery, I think it's also very foolish, because the latter part of this is not going to be as quick. I talk to business owners all the time, and restaurant owners saying that, it cost them $200,000 to reopen one of their many chain restaurants. So it not only requires money, it requires time. But we will recover. So here's the great thing about being in our business is that, let's talk about, just real quick, if I may, what we expect for rates and what we expect for real estate. And answering the question on rates, I think that from an interest rate standpoint, you're in for very low rates for a very long time. It doesn't mean that there wouldn't be moves up, but you're never going to see a 6% handle on a mortgage. And you'll probably see, for the most part, interest rates remain solidly below 5%, maybe mostly below 4.5%. And the majority of the time, definitely in that under 4% range, with periods where you can get right around 3%. The capacity issues will add a premium, and the servicing losses, you have to figure, if your servicing was worth 1 point and you're going to have to book it at 0, that's a definite translation to you lost a point, which translates to 0.25% in rate. So you got a 0.25% in rate premium. You're going to have a capacity premium. But I estimate that there are between $4 and $5 trillion, even with those levels, of mortgages that will be eligible to refinance. In a great year, our industry can handle $1.5 to $2 trillion. You had a banner year if that's the case in refis, because the other half would be purchases. So you're going to have more business than you can handle. You're only going to be limited by how hard you want to work and how many hours in the day. That's fact. Okay, so to worry about the short term is so stupid, because the long term is so good. So sacrifice. This is the John F. Kennedy moment. This isn't what can you do for me. This is what can I do for my company to keep you there, because we need you there, because the future is so unbelievable. Now, how about real estate? So as you know, I'm very, very detailed on by zip code, figuring out what's happening in real estate. And we've done a good job. But I also have tremendous amount of respect for a few of my colleagues. One that I have a tremendous amount of respect for is Ivy Zellman, who not only is a sweetheart and a doll, and I love her, and she's so smart, and she's been so willing to share. And Ivy thinks that we will see a drop in real estate values that's pretty gentle, maybe 3-4%. Now, I think it'll be a little deeper than that, between 5 and 7%. Another very brilliant man, love him too. He's just such a great guy, is John Burns. He's a genius, and he's wonderful with understanding what's going on in the housing market. He thinks because employment will come back slower, and who knows, he could be right. He thinks it's close to a 10% dip. Now, I'll tell you why I think we're where we are. Now, first of all, we're talking residential. I think commercial is in trouble, because what we're all discovering right now is that it might be better to work without the overhead of space. We can be very efficient this way. So if anything, this is hurting the commercial market more than people are anticipating right now. But it's also helping suburban sprawl. Is there any better reason to buy a home and not be in an apartment if there's a threat of a virus around? Okay. I mean, we could see what's happening in big cities. You could see what's happening in New York and others. This is a big reason to buy a home in the suburbs. So I think that that market will come back very strong. As employment comes back, this should be viewed as an incredible opportunity. Before we went into this, every single metric was flashing, you should buy. And, you know, a lot of people for the last several years got this wrong. I'm very proud to say we were about the only ones who got this right and dead on where real estate was going. And I'm telling you that you should look at this as an opportunity to buy a home. A month ago or so, when Corona was a beer, you were frustrated when you tried to buy a home. You were outbid. There was no inventory. Now, to the extent you can, use this period to teach your clients, if you're a realtor or an LO, that this is the opportunity. If you're an LO, teach your real estate agent that this is the time to buy a home, because the other side of this, and people tend to stay there for a long time, on average 10 years, they will look at this and be so happy that they grab this period of time where they can get terms and can get a better deal.
Yep. Fully agree. Beth Kaczynski wants to know what permanent changes might be coming to the industry as a result of this crisis. Anthony, I want to start with you, and then we'll get a follow-up from Aaron.
I think for starters, capital requirements are going to change pretty substantially. If you want to service loans, the capital requirements are going to be bigger. And just taking a step back, the fact that, you know, this thing started on March 13th, and within 2 weeks of this starting, we saw MBA very publicly, you know, going to the Fed and the Treasury Department and saying non-bank lenders are out of capital. They're having this liquidity crunch. And if you put that in perspective, you have to realize that that headline is going to come back and be something that we have to reconcile, meaning in 2 weeks, people ran out of money. So they're going to require more capital out of our lenders. So the barrier to entry to become like a real player, like doing what Aaron did and building his company. Aaron, what year did you start your company?
2007.
So like that opportunity, probably not going to happen again. Meaning like, you know, moving forward, there's going to be a bigger barrier to entry to build a bank, a non-bank lender. So that would be one that's going to happen. I think we're definitely going to see a reevaluation of the way loans are priced. Right now, servicing values, there was already a lot of talk about prepayment speeds and really what is the correct value for servicing. I think this is going to put a bow on that conversation, and we're going to see a change that impacts loan originators. And I think the reality is that, you know, loan originators are going to probably see lower comp levels in the future because of the way MSR values are reevaluated here at some point in the next year or two. But that's just my opinion.
Aaron?
His opinion might be dead on. I'm a little bit more pessimistic about this industry and its ability to do intelligent things and not learning from the past. Again, it's probably not a popular statement amongst mortgage individuals, but I'm probably the only CEO of a mortgage company that was pro Dodd-Frank, and for a couple of different reasons. And don't get me wrong, it's not perfect. I'm not like in love with that regulation. It just, since the formation of Dodd-Frank, is myself, including practically every employee that's ever worked for me, has made more money than they ever had in this industry post Dodd-Frank. Yeah, and it's painful, and and you have to jump through extra hoops, and it's a pain in the ass, so on and so forth. We all understand it's not perfect. No regulation is perfect, but it probably, had it not gotten into effect, this would be a far worse situation than it is now. So maybe a little counter to what Anthony says, and he could be dead on right. And in some ways, I hope that he is. I think it largely has to do with administration. So the current administration wants to deregulate. Most of the people in our industry wants to deregulate. They want to be able to take out more leverage. I mean, 2 months ago, there's been cries, I mean, that's gone on for years, about allowing companies from the size of my company to very large banking institutions to be able to take on even more leverage, right? So are we going to learn from this that maybe we're all a little bit undercapitalized? Should companies like mine have to take on, have more liquidity, more assets to be able to lend? Should the broker requirements have to maintain a higher net worth? I mean, or what's going to happen? And let's just say, like in the state of Arizona, you have to have a $250,000 net worth to be a mortgage banker. You have I believe it's a $60,000 net worth to be a broker. So if we behave more responsible for the next pandemic, and we increase those standards, right, which we all might right now say, hey, maybe that's a good idea, and you take the mortgage broker to a $250,000 net worth, and a banker to $1 million net worth, what's the outcry of this industry going to be then? So we like to talk out of both sides of our face, and he's right. Maybe we will get smarter as an industry and make things a little bit more challenging to avoid, this kind of situation for the next pandemic, but I'm not holding my breath.
It's interesting, Aaron, you bring up leverage ratios, and I think that's what this all comes down to. In 2008, they brushed off the Volcker rule, and they started looking at changing capital reserve requirements. And even a year before this whole thing came out, they started looking at stress testing non-banks. Jenny was coming out and talking about stress testing our wholesalers and non-banks because they didn't think they had enough in capital reserves. But consider this, the government who thinks that mortgage companies are undercapitalized right now. Fannie Mae and Freddie Mac have a leverage ratio of 141 to 1. I mean, completely and totally undercapitalized. It's just kind of ironic to look at it that way. But I think coming out of this thing, it was the same thing last time. It's going to be the same thing this time. They're going to start stress testing and looking at more capital reserves specifically for non-banks.
Yep. So Brian, Humphrey Brown would like recommendations for newbies coming into the industry. Quite a time to come in. And he wants to know how they can prepare for the opportunity, as Barry talks about, after this is over, the hot opportunities that are going to be out there. How can they best prepare?
I'll tell you what, I think this is the best time to get in the industry. I really honestly do. Because the lessons you'll learn, you're going to cut your teeth in this market. If you can make it through this market, when markets get good, you're going to have the skill set to really take advantage of markets. When you come into a hot market, we have this certain level of entitlement, and we assume that everything is always going to be fast and easy. Remember 2005, you had like New Century, just send it in. But hold on, I got a 5-4, just send it in. I think this market, the people who are coming into this market right now and can succeed through this market are going to do a great job. My thing is the only enemy to a loan officer is personal accountability and discipline. That's really what you have to have. If you have personal accountability to where you're setting your goals and you're having a purpose-driven day, week, and month to meet those objectives, and looking back on the week and evaluating, what you were doing, did you meet, succeed, or fail those objectives, and learning how to be nimble and change what you do. It's that type of discipline that's going to make a loan officer succeed or fail. It's always been this way. And here's a dirty little secret. One of the products that I work with is called Listing Booster. And it does a bunch of lead capture, and it does a bunch of great stuff. My top 5% loan officers across the country who are great at Listing Booster, they don't need it. They're going to be great at anything. They're going to find anything, any product, and they're going to succeed with it. On the other side of that, the bottom 5% are never going to succeed with anything. You have a great banker, like Aaron has a great loan officer. I hope more than one. I'm sure he does. But you could take your top 5% and they can go down to the broker channel. They're going to succeed. It just doesn't matter. You can take your top 5% brokers, turn them over into bankers. They're going to succeed. And the only common denominator, and I look at this a lot as I travel around and I speak with loan officers, I try to find threads of similarities, commonalities amongst people who succeed and don't succeed. And it's not gender, it's not race, it's not age, none of those things whatsoever. It seems to be those who, one, do not feel entitled to their business. They're always in grace or grateful for the opportunity to work with other people. And when you are grateful for the opportunity to work with other people, you never take it for granted. And two, they're never comfortable with where they're at. They're always looking at ways to tweak their business and make it better. Let me give you a quick little anecdotal story. I was down in Florida in Tarpon Springs. It was probably a decade ago. And I was doing like a 3-day speaking gig down there with Carl White and some of those guys. And everybody kept telling me about some guy who was writing more VA loans than anybody in the country. And I had this guy, this short, kind of heavyset older man. He had to be, late 60s, early 70s. And he kept coming up to me and saying, God, I just really appreciate everything that you do. And oh, well, thank you. I appreciate that. And he would say it like 2 or 3 times a day in some variation of that. And then on my 3rd day, I'm like, who is this guy they keep talking about who writes more VA loans than anybody in the country? Him. You got to be kidding me. Like, that is not the profile of a top producing loan officer. That was my mindset. Just never in a million years, And then he came up to me as I'm getting my breakfast on the last day. He goes, I just really appreciate everything you're doing. I said, you should be up on that stage talking, not me. I should be listening to you because you've clearly figured something out that I don't understand at this point. My point is this. In tough markets like this, I think people learn gratitude. I think they really do. I think entitlement is just way behind you. And if we can hold on to that gratitude and have personal accountability and a disciplined approach to our days, weeks, and months, everybody needs to be on a calendar. That's how you can really account for what you're doing. If it's good enough to put on your calendar and you have it hooked up with your phone and then it beeps and says, hey, you've got to go do this marketing thing and you dismiss it, then you're just lying to yourself. So personal accountability. And I think this is the best market and the best time for loan officers to figure out if they've got what it takes to make it. Because things will, I agree with Barry, well, everybody on this panel, things are going to get better. It's not going to be overnight. We're not going to flip a switch, but we will start to slowly get better as we're coming out of this thing. And when the market gets good again, the skills that you're learning today are going to serve you in the future. And Aaron, real quickly, and I think Barry was talking about this, as we're coming out of this and as we start to, let people out of their quarantine and go into their houses or go out into our communities and start to really look at our economy, which is suffering horribly from this, keep in mind, this thing probably will spike again and again. The Spanish influenza of 2018, it had 3 separate spikes in this country. They were doing the same thing we're doing right now, which is quarantining. They didn't have any vaccines at that time. And as we let people out, we are going to see spikes. But the great thing is we're starting to find ways to fight this thing, to mitigate some of the symptoms, and to ensure that all our healthcare workers have all the tools available to them to not only help themselves, but help us.
Very good. Anthony, several viewers asked about the impact on broker shops through all of this. What are you seeing as the biggest challenges? And does it differ from the challenges independent lenders face, or are we all rowing the same boat right now?
I think it all relatively boils down to the same issues, but I will say that, for the most part, what's happened is over the last couple of years, there's been a lot of new LOs that have come into the broker channel, as that's been, pretty well documented. And these guys, I cut my teeth being what I consider like a real broker. I had, 25 lenders, you did some loans here, you did some loans there. That was the way you brokered back, when back in the day. But now a lot of brokers just kind of became, captive brokers where they did all their business with, this lender or this lender, and then they might spread out 10% of their business. So what this has forced a lot of people to do is learn how to be a broker again and to work with a lot of different lenders because of the fact that, certain lenders have been quicker to restrict credit than others. So, one door closes, another one opens. So that's been a big change. And that's something that, a lot of people have been struggling with is learning new platforms and learning how to be a true broker again. And I would say the other thing is, for the most part, this is a group of people that, they work from home. They're used to, kind of this environment to a degree. They're pretty nimble. They're pretty resilient. They've gone through a crisis before, the financial crisis. Like a lot of guys have, survived that. And the truth is, we got a lot of great leadership. I mean, Barry's been, doing a weekly, Zoom for our group every single week and giving us an hour. And we bring on different industry leaders like Kevin Perano and Dave Stevens came on, and we're listening. So, I think that's the one thing I've been really forceful with is making sure these guys understand what's going on. And it's not that they're always listening. And even today, I just, I'm getting questions on things that we talked about weeks ago, but, they're in the same bucket as everybody else here, relatively speaking. They're just smaller and dealing with it in a different way. So I would say we're all relatively dealing with the same pain.
Yep. And I know you have to hop off early, Anthony, so I want to give you the last question that everyone else is going to get. What is your advice in a few words for everybody for the next 30 days? And yes or no, is this 2008 all over again?
So number one, my advice would be long-term focused. Okay. The one knock that I would say I personally have on loan officers, and I really don't care what anybody says, is they're not long-term focused. And they're very transactional in nature. Like, realtor calls me and says, if I don't close this deal, it's the end of the world. That's not a real relationship. Explain the situation. Explain why, credit just got restricted. Non-QM's gone. When I hear loan officers tell me that they're going to lose a relationship over, a transaction that they can't deliver because nobody can deliver it, you're not building long-term relationships. So, to me, now's a time where relationships matter, partnerships matter. Be a better partner, bring value to your partners. To me, I watched Barry. I saw a guy the other day. He took what Barry did. He created his own screen share. He provided some commentary over it, and then he inserted Barry's commentary. It was great, and that's how he's bringing value to his realtors and to his community. So, focus on value. Be long-term focused. Understand that being right now, there's going to be an unbelievable opportunity for the smallest and the nimble people that make it through this. A lot of people are going to shake out. A lot of people are going to go away. And that's not a bad thing for the people that are in this for the long haul. And as far as that last question that you had, what was the last question?
Is 2008, is it 2008 all over again?
No, it's much worse. It's much worse because in 2008, that was, in 2008, realistically speaking, that was concentrated on one part of the economy, housing. This is a real, this is a health crisis. We're taking on trillions of dollars in debt. Back then when we took on the trillions of dollars in debt, we had people that could repay it. Fannie Mae, AIG, all those institutions repaid it, and the taxpayer got their money back and then some. Where is that? Who's repaying this? We're putting a lot of money out there, and the question that a lot of people are going to have to ask is: we just had a huge tax cut as a nation. How are we going to pay for this? So on the other side of this, it gets. Things can be a little murky when you really think about this long term. But end of the day, we got through 2008, we got through 9/11, and we're going to get through this. And the strong will not only survive, but they'll thrive.
Yes, we will.
Thank you, guys. I appreciate all of you, and you guys are doing a heck of a job. Continue to lead and continue to do what's right for your companies and your employees and your communities. So thank you very much.
Yeah, Anthony, you're doing a great job, man. You guys, you two, Brian, you and Frank. The work that you guys are putting in and the information that you're putting out, it's really amazing. The leadership role all you guys are taking in our industry, and I just want to personally thank you guys. It's incredible what you're doing, and believe me, I know it can be exhausting. So thank you, guys.
Thank you, Barry. You're the man. Bye, guys.
Thanks, Anthony. So, Barry, we have a really unique question, a great one from Dennis Marshall. He asked, post-COVID, if you were to create an entirely new MBS that would have the most impact on the mortgage and real estate industries, what would that look like?
So if you take a look, I'm not saying I would create this, okay? So I'll tell you what's more realistic is what I think people will be looking at. So we tend to have the mindset to fight the last war. So where was the exposure here? What almost took down the industry were margin calls. So margin calls were done in great extent. And I have to tell you that I'm very proud of this because companies that didn't listen to what we were putting out there were locking at the wrong times, which made them much more vulnerable. So all of our clients are thanking me for doing the right thing. We didn't put out a lock alert in 2020 until March 9th. So until the Fed took that crazy week where they were buying mortgage bonds at $183 billion after $67 billion week, we were all in the good as far as margin calls go. But because of this, I think that you'll see less long-term rate locks, or they'll be much more expensive because there will need to be an additional cushion to take on that exposure. Second, the value in MSRs, depending on where they land, don't be surprised if you see more stringent prepayment issues. I also think that, as I mentioned earlier, it won't be uncommon to see people, in order to get a better rate, maybe you incent them by giving them a much better deal if they pay 1 point, where the buy up to get a point would result in, not the normal, like you pay a point, you get a 1/4% better in rate. Maybe you pay a point, you get a 0.5% better in rate. So people will be incented, not forced to do that. But I think that that's something that's going to be realistic. So I think that underwriting standards might require a little bit more reserve to absorb shock that you would have. So there's a lot of things that I think will come out of this that will make it more of a pain in the ass for us to do the transactions. But the good news is we're all going to be in the same boat. So it won't be indigenous to you, your company. And for long-term survival, I could see this happening. I could see these things happening. I don't know if they happen in that way, but I will tell you, I know they're being discussed. And I know that when we do come out of it after crisis management, for longevity, people will look at this. But I think that we need to focus on, how fortunate and blessed we are right now, because, while you've got serious issues that you're working through right now as a mortgage originator, and frustration and heartburn, the fact of it is you're working and you're making a lot of money and you're closing a lot of loans. And, I think perspective is always, like I begin each day with, literally, I say out loud all the things that I am so grateful for. And it's a long list. And that's the way I start my day every day. And it gives me a lot of perspective to be able to handle certain things that are not favorable, because there's so much good we all have. Yeah. So if we just start with that perspective of how lucky we are, we got this. I mean, think of all the things we've been through, right? I mean, you're going to be able to manage this. You're going to be able to get through this and have an incredibly successful, wealthy career in this business. So we just got to deal with some few hiccups along the way. Yeah, it's going to be a little bit of bitch. Yeah, it will be. I mean, I look at when I originated loans compared to what you guys have to go through to originate a loan. It's a big difference, but you adapt and you figure it's the new normal. So it's just going to be that. There's a lot of opportunity going forward that the focus needs to be on.
Aaron, Stacy Steen would like to know what originators can do to better prepare their borrowers for closing during this unique time.
To better prepare their borrowers from what?
For closing.
For closing?
Yep.
Well, let's put it this way. The single greatest fear that I have going forward right now, because like I stated, is that once people get back to work, this thing's going to start to get behind us. All the problems that we have are going to start slowly subsiding. I don't think it's going to be overnight, but it will happen. But the greatest fear that I have as a company owner is people, funding a loan and then calling us up the next day and saying, how do I go into forbearance? That right now, without the government intervention, that could be a catastrophic event for our industry, which is what we've been talking about largely. So we've been spending a ton of time educating, past clients, current clients, people that are in process about forbearance and what it means not only to them, because again, there's a lot of misinformation out there why they think that, well, hell, I could just not make a mortgage payment for 12 months and go buy a boat and it's not going to have any negative impact on me, which it will. I mean, we already know written statements from a lot of the biggest servicers in the industry is that they will not do another transaction for them on a purchase or a refinance had they gone into forbearance. So, and we've all already seen a credit report where it says clear enough, forbearance right on it. It's not reported late, but it says forbearance, clear as day, right? So it is going to have, I think that once we come out of this and once all the lenders really start putting the pieces of the puzzle together and the dust settles, is they're not going to want to take on the borrowers that did this, right? Especially if it was catastrophic, not only to the industry, but also to housing. So if all these people entering into forbearance, cause a severe economic harm on the housing industry and the mortgage industry, we're not going to want to do loans for them. So we're getting our loan officers to go out there and educate not only their real estate agents, which need to be educated, their referral partners, CPAs, financial planners that largely don't have any idea about this, and the clients that they have in transaction, and have a conversation with them to try to prevent this from happening. And not only that is, like they stated earlier on, is with most of these people cooped up in their houses, they have plenty of time, right, to reach out to everybody they should have been talking to on a regular basis prior to the crisis. And if loan officers do this properly, they're going to generate a lot more referrals, prevent a lot of harm, and look like they'll come out of this looking like a saint, which will be great for their future business. But like Anthony said, or somebody else said, is that you got to look at the greater good. And it's not just the greater good from a loan officer perspective, it's not just the greater good for your company, because your company's survival could absolutely have everything to do about how you handle your clients going into this. But it's not only your company's survival, it's the economy. It's the entire U.S. economy could lie in your hands and how you handle this crisis.
Absolutely.
So right on, by the way, Aaron. Very well said.
Thank you.
Brian, we got a lot of questions in the pre-submitted survey about digital closings. Do you see the industry, which has traditionally been slow to react in the technology space, do you see us making swift adjustments across the board to support social distancing in the closing process?
Oh, I think that's inevitable. I think we were on that track to start with. Is this going to expedite things and make it a little faster? I hope as quickly as we can do it responsibly. I think, but clearly, how we write loans and how we sell real estate is going to change. I think this is going to have, it's going to have a social impact not only on the mortgage and real estate market, but really kind of how we interact with each other collectively. So I think it certainly is going to expedite it. I don't know if they can go much quicker than they can right now. And this is the fog of war. We were comparing this to 2008. We had 15 months in 2008 as we saw everything start to disintegrate. We saw this all happen in 3 weeks. And so there's more pressing issues right now that I think need to be addressed. We need to straighten out our servicing. We need to, Aaron was just talking about a moment ago, these loans going immediately into forbearance. There's almost it almost feels like if you go to the Consumer Financial Protection Bureau site and they just recently put a video out on these forbearances, it almost seems like it's encouraging people to get a forbearance on their loan.
Crazy.
I think I 100% agree with what Aaron just said a moment ago. What we need to do immediately is we need to be counseling our loan officers and look at the type of profession that person is in. Is this a job that is going to be, scaled down, scaled up, and counsel your clients, talk to them about what's going on with these forbearances. We were talking about the credit report, Aaron. We just had a conversation on this. Is it going to show up on your credit report or not? Well, here's my whole point. It doesn't matter if it shows up or not, because when you order that payoff, it's going to show there and they could kill the deal at the last second.
Hey, Brian, you know what I want to just mention to your point, because I think you're so spot on, is that, I think the guys that are on this call, many people listening, we've got a few years under our belts here, right? This collective group especially. And, Aaron, you started your company right around 2007. And what I remember is when people would say, well, what do you do for a living? What kind of business you're in? Well, I'm in the mortgage business. It's like, it was kind of a bad word, right? Can I tell you, everybody listening, how unbelievably proud of you I am? Think about what you did. Think about what the leaders of this company have done. Aaron, you've got all your people pretty much at home. You're at home, right? But you're still closing all these loans, right? You have transferred without missing a beat. Think about what the leaders in this industry have done. And I am so proud of them that without missing a beat, people working at home and the loan officers have adapted. The leaders have adapted. I mean, you think about what we've done. My goodness, you think people should be really appreciative of the job the mortgage industry has done to protect the well-being of people in this country. You want to buy a home, you could still buy a home. You need to take money out because this is the time when you need it. You could still get that. We'll save you money on your payments. I mean, other than the medical profession, this is such a wonderful business that you're in, that you're doing so much good. I'm so proud of each and every one of you. And now, if it isn't enough on your shoulders, think about what Brian is saying here, is that now you don't make money doing this, but you're going to take on the additional responsibility to save the housing market, to save the liquidity so you could buy a home with the mortgage market by now making calls and explaining to people that they need to be good citizens and don't abuse this process. I mean, just think about what's on your shoulders, and you're rising to the occasion. I mean, I am so proud to say that I am associated with you guys in the mortgage business right now. So sorry, Brian, I just had to say that because you're so right on your point, and I just wanted to emphasize how much I believe in what you're saying.
Well, and just real quickly, Barry just said a moment ago, outside of the, the folks in the front line helping the people who are sick with this, the mortgage industry is right up there in terms of getting us through this industry. Now, for some of you who are rolling your eyes on that, I want you to think about this real quickly. If you give somebody a refinance, they skip a payment, they get their impound account back, and they get a lower overall monthly payment, the best stimulus package that our country has to offer right now is you and the products that you have available to you. That's a fact. Think of how much cash that frees up when you deal with any type of refinance. So yes, and by the way, it doesn't cost the taxpayers a darn dime now, does it? Which is even better. I always kind of think of it, I think of it this way, Barry and Aaron, is I think sometimes people have reluctance to make those phone calls, for refinances. I think some of the reason is because they're thinking more of their check than they are the person. Let's not look at ourselves as salespeople today. Let's look at ourselves as community advocates. You have an obligation to your community to go out there and get as many people refied as possible, because that is effectively the best stimulus package in the entire country, and you have it at your disposal. And we're all hoping that you take advantage of this opportunity and be the best form of you right now as a loan officer.
Yep. And also, to the extent you can, people have equity in their homes right now. The average LTV on, by the way, 40% of homes are owned free and clear. So here's some math for you. It's 128 million households in the US. That means that when you take a look at, there's over 30 million households owned free and clear. 30 million homes, no mortgage. There's about 50 million homes with a mortgage with an average LTV of 53. 53. Why not take some cash out, wipe out their debts? To your point, Brian, you're 100% right. It's the best stimulus plan, because if the government's going to give you a handout for $1,200 once, you could pay off all their debts with cash out. Give them a cushion so you don't have to sell your stocks at a discount. Give you a cushion for a rainy day. Save you $1,500 to $1,800 a month every single month. And then when the crisis is over, you take that savings, you can take that cash, maybe you've invested it, but accelerate your mortgage payment by that amount. So you keep your payment the same as it is now. And now you save 12, 15, 18 years worth of mortgage payments, saves your customer $3,000 a month for 15 years in the future. How's that for a stimulus plan? And builds equity in their home that they could use now, because they'd have a home free and clear instead of 27 years from now, 13 or 14 years from now, that they can use for their retirement, their kids' college. You have the power in your hands to do so much good. So when you're going to do a loan for somebody, if it's a refinance, don't think about save a couple of $100 a month. It's nice, no question. But that's like $43 a week or something like that. $6 a day. That's not going to change anybody's life. That's just nice, but it's not going to change your life. You use the strategy that we're outlining here. That will change people's lives. And that's what you really need to be thinking.
It will. And that's a perfect segue into the one question that I wanted to take in this. We had several people ask what they could have done to prepare themselves better for something like this happening, not knowing that it was coming. And my answer is very simple and clear. It's planning and marketing and positioning yourself as an advisor, as someone that they trust to reach out to. Because if you are in their eyes that person, when this all started to happen, you would be the first phone call that they're making. And if you were that first phone call, then you're going to be the first person that tells them, don't go into forbearance. This is why. These are going to be the repercussions to you. So always, no matter what's going on in the industry, what's going on in the world, always be setting yourself that way and communicating constantly to your past clients and being that advisor. Call them on a quarterly basis. How are things going? Are you looking at doing any investments? Can I connect you with a CPA? Can I connect you with an attorney? Can I connect you with whatever? Always be connected with them so that when these things happen, they're calling you. You don't have to pick up the phone because they're entrusting you to that. Also, additionally, you want to be prepared constantly for crisis marketing. Crisis marketing is so very important. I immediately went into action on what do we need to educate the consumer on, what do we need to educate our business partners on, what do we need to do, how can we help the community, how can we be out there, what public relations is involved. You should be prepared at all times to do that. That's a whole other webinar of its own. Maybe we'll do that at some time. What do you got, Barry?
James, I wanted to mention, you're so right. And, you know, think about during crisis, there's opportunity. There's such an opportunity now, team, because there is really a lack of information that's out there. And you have the ability to gain that information. I mean, you listen to Frank and Brian's show. Hopefully you subscribe to MBS Highway. I mean, we try and put that out every day. And, you know, you can really rise to the occasion now and be a local celebrity. Now, you know, a great way to market would be if we could take out a commercial during the Super Bowl, but it's not that easy to fork over $5 million to do so. But I'll tell you what's even better is that social media is free. And that's why if you listen to what I think, listen, let's face it, Brian, you pioneered this, okay? You and Frank were the first ones to teach people to do videos, to put it on social media. You were the pioneers of this in our industry. And, you know, we've kind of said that let's try and help as well. So that's what we put, as you guys know, you know, Aaron and James, we put out scripts for all this stuff within MBS Highway that are easy to read and post. This is your chance. People are home. They want to listen. They want to learn. Why don't you be that guiding light right now? Get this information, get on social media, create videos that people could learn from, that could benefit from, give them hope for the future because that's what they need. And then when you do that, I promise you, it will endure beyond this period and you will build such a great following for yourself to help your business into the future. Do that right now.
Yep. Okay, Barry, what's on the other side?
What's on the other side is a period of time, as I said, the unlockdown period, where it's going to be a period of adjustment. It's going to be a period of slowly feeling like it's normal. We get the benefit of seasonality. We get a therapeutic response, but we're still going to be tentative and businesses will have a tough time. We get to about the end of this year where you see a vaccine and people start to become inoculated. We're going to be back hugging each other and high-fiving each other and being close to each other again and, you know, complaining that we got a long line that we're waiting on for something that we want. Okay. Now it's not going to happen instantly, but what I will tell you is if you're driving at night on an old country road and, you know, it's dark, you can see what the headlights are shining on, but that's about as far as you can see. But you keep driving because you have faith that there's more road ahead. And that's really the part that you can see that you're shining on. That's a very small part of the journey. Okay. That's a really small part. And what I'm telling you is that in this time, when you're frustrated, you know, when you're worried, when you're scared, I mean, heck, I'm not ashamed to admit that I'm afraid of some things that are out there for my family first and people that work with me and my friends that, you know, I care for them and I want them to be safe and healthy and I want to be healthy myself. I mean, I worry that, you know, I want to be safe and healthy. I want you guys to be safe and healthy and your families. So you think about that worry, you think about the frustration of getting through this time, but that's all that the headlight's shining on right now. I want you to believe and I want you to know that beyond that, there is so much that we have to look forward to. The other side of this is going to be a very long period of time of great opportunity, low interest rates, incredible refinance opportunity, incredible opportunity on the home buying side, on the residential area that, again, as I said earlier, you're going to only be limited in the amount of money you earn by how much you want to work and how many hours there are in a day. That's the only thing that will limit you. So just don't lose sight of that as we go through a bumpy period here. No doubt, let's not sugarcoat it. It's going to be bumpy. It's going to be treacherous, but think like a CEO and protect your company. Take care of yourself. Look at the opportunities that you have today to be a leader. And that's what you want to do. Somebody said it earlier, Aaron, I think you said be the best self you can. Brian, you said it too. The best version of you that you could be, that's what you want to be.
Excellent. Aaron, next 30 days, what should people be doing?
Social distancing. For the next 30 days, I mean, let's put it this way: from a loan officer perspective, like I stated earlier, is that most people, I believe, got into this business to make money. They don't say that publicly, which I thought was always funny. Usually when I ask a loan officer why they got into this business, they say, well, to help people, right? It is what it is, okay? You can tell yourself whatever the reason is, but if it is to help people, like people usually say publicly, their reasoning for being in this industry, now is the time. And now is really, really the time that you can help people. And like I stated again, and I just need to reinforce how important this is to your clients, is go out there and help them, have conversations, see what they need. If they have needs beyond your mortgage needs and you can help them financially, providing groceries, whatever it is, whatever is capable in you to be able to assist those people. There's a lot of people in pain right now for a variety of different reasons, whether it's financial stress or it's health issues, or they have family or friends that are hurt by this. If they don't need anything else but just to have somebody to talk to, you can be that person for them too. As far as the mortgage space goes, there's a lot of things that we can do for people right now as far as bettering their financial situations, through a refinance or whatever it might be. But again, educating your clients and your future clients about avoiding the possibility of going into a forbearance that will hurt them. And again, it will absolutely hurt you. It'll hurt your company, and it'll hurt this entire country if we don't do that. And I can't tell you how important that is. And probably in the next 30 days, that is the most important thing for you to do. For some of the loan officers out there that might be feeling some strain because of interest rates and the competitive nature of the market right now, it's going to pass, and it might take a little bit of time to pass. And if you go out there and reach out to as many people as you possibly can with the sole intent to be a good human, is you will generate a tremendous amount of clients to be able to make more money than you ever thought you would make, but it might be Q3 or Q4. Right now, not just the next 30 days, but at least in Q2, do everything you can to help people. Help them. And I promise you, the residual effect will be tremendous. And if you truly are a good human and hold on to those wonderful things that you do in the next 30 days, hopefully it'll stay with you for the rest of your career, and you will be a tremendous success because of it.
Love it. Excellent. Brian, next 30 days.
Well, I want baseball to come back. I miss baseball. I think that's a big one. I'm kind of rooting for baseball to come back. I hope something new comes out on Netflix or Amazon Prime, because I've watched everything. The next 30 days, guys, look, we can only control what we can control. I mean, as a loan officer, that's it. A loan officer working for Geneva has faith that Aaron's going to make the right moves to ensure that they have the products and the processes and the liquidity to go ahead and write those loans, which Aaron has done a fantastic job with. I speak with a number of his loan officers, and they've got great leadership over there, along with a whole bunch of other companies. Aaron's got the burden of managing his loan officers and managing his company, which, by the way, I wouldn't want to be you right now. I mean, you're wearing a lot. You're wearing a lot of hats. You're wearing a lot of hats. But from a loan officer's perspective, look, all we can do is control what we can control. Turned out 2008, when I was in the middle of 2008, it was the worst time of my life. Not kidding. I found out I was having a kid in the middle of 2008. I was literally outside of Las Vegas. My wife had flown home, and I was driving home with my two brats, and I got stuck for 2 days driving back around Christmas. And I called my wife and I said, "Are you okay?" And she goes, "Yeah, but I'm pregnant." And it was a seminal moment in my life. And 2008 was the worst time ever. In hindsight, it was the best thing that ever happened to me. Because what I decided to do when I found out I was having that kid is I decided to mobilize and focus on my business and get outside of my comfort zone. And, I got comfortable being uncomfortable. You know, because I had a kid on the way. And when I look back on the decisions I made then it's why I'm here today. There's no question about it. Without 2008, I would not be here today, because I had to have something that spurred me to be better than what I thought I was capable of. So right now, you know, I know there's a lot of people out there who I'm sure their production is starting to, you know, maybe slip a little bit. Maybe you're seeing rates that you think are not right. Maybe you're seeing fees that are a little higher than you thought. Maybe you had some jumbo and non-QM deals fall apart on you. There's a real easy chance to have a pity party. But that's the absolute wrong move. The leaders of tomorrow are going to be made today. That's just the truth. I mean, I was a young man when 2008 hit. You know, I'm on the downside of the slope now. Not that far, but I am on the downside of the slope. So, you know, the leaders of tomorrow are going to be made today. And so just understand, control what you can control. Be proactive, reaching out to your clients over the next 30 days. If you're stuck at your house, treat your quarantine like a job. Time block, reach out to your past client database, reach out with your real estate agents. My God, shoot a video. Even if you don't think you can shoot a video, shoot a video. I mean, all thumbs the whole way through it. No one's going to hate you if you shoot a crappy video. Nobody's going to take you off their Christmas list because you shot a crappy video. It's just never going to happen. But when you're shooting your videos and you're doing this in your community and you're taking what you heard today, we're really expanding this message. And we have very important things to say that can help not only our pocketbook, but help our communities as well. So do what you can do with the time that you have right now and make the most of it. And it does require a certain level of personal discipline.
It does. Well, and what an opportune time with this interruption. If you're not getting your hustle together at this point, I don't know what you're doing. Gentlemen, I really appreciate you taking the time today. As I said, I know you're all very busy, but this is going to be great for education. We'll be getting it out there, the recording out there, and I believe this will inspire a lot of people to work harder to help this industry and this world get through this. So again, thank you for your time. I'm sure we'll be doing this again sometime soon.